So Chris Hansen from Dateline NBC did an undercover story about advisors who sell annuities and how they go to this annuity school not to learn about annuities, but to learn about how to sell annuities. The art of how to convince people to buy annuities. And the very first thing they learn about is the art of selling fear, scare tactics. And I already covered the number one lie about index annuities in another video, which is selling fear of the stock market to investors who are ignorant about diversification and how when stocks fall, money runs to the safety of bonds. But sometimes investors are already familiar with diversification, and so this scare tactic doesn't work. So then these advisors move on to plan B, and that brings us to the number 3 lie about index annuities, which is when Mr. Commission-based advisor tries to convince you that bonds are too risky and that you need to take just the bond portion of your portfolio and put that money into an annuity, which is, of course, a big mistake. Because for starters, if you put your bond money into an annuity, it eliminates your ability to rebalance. You can't rebalance an index annuity, and you can't rebalance the stock portion of your portfolio if the stock market were to drop and your bond money is stuck in an index annuity under threat of a 15% surrender penalty and nasty tax consequences. Rebalancing is a simple, basic strategy that all smart investors use to maintain their stock-bond allocation ratio so that they're not taking on too little risk or too much risk. For example, you can decide to rebalance on the first trading day of every year, or you can decide to rebalance if and when the stock portion of your portfolio deviates by plus or minus 5%. Some people like to just play it by ear. Just imagine in 2009, after stocks had dropped 30%, 40%, or 50%, by owning a bond stock portfolio, you had the opportunity of a lifetime to take advantage of what inevitably happens next. When stocks go down, they bounce back up. But if the bond portion of your portfolio is stuck in an index annuity, you can't rebalance. You can't increase your returns. You are stuck in the mud. So anyway, I decided to crunch the numbers and see how the Barclay's Aggregate Bond Index performed versus this popular index annuity that you've probably read about. And sure enough, this index annuity was beaten by over $16,000 after 15 years. And again, this doesn't even account for any rebalancing. And by the way, if you're thinking, well, you just picked one annuity. No, index annuity products all provide about the same types of returns. There's no insurance companies out there playing Santa Claus. They all have overhead. They all pay advisors fat commissions. Insurance companies are all for-profit corporations. They all do the same thing with your money when you give it to them. They turn around and invest it in fixed income, and they take a little and put it in an S&P 500 derivative. They also all have mathematicians who know, based on historical performance of the markets, how much they can and can't afford to pay out. And insurance companies all have to compete with each other. You study one annuity and you have a really good idea what the others are all about. And finally, the other thing that commission-based advisors have been doing more recently is to try to use fear of the so-called bond bubble to scare you into dumping your bond money into an annuity. But in reality, if you've read up on this bond bubble that everyone has been talking about, you will discover that it's overblown on many different levels. For starters, nobody knows if interest rates might stay low for years and years to come. And a lot of investors don't think that the Federal Reserve is going to allow rates to shoot up. The Fed doesn't want to rattle the markets. But either way, when you invest in a bond index fund like AGG, which seeks to replicate the total bond market, you are investing in a laddered portfolio which contains bonds that are maturing all the time, sometimes every month. So if interest rates go up, bond prices go down, that's a bad thing, but those lower yielding bonds are being replaced by higher yielding bonds that produce more income, and that's a good thing. So if you don't panic and sell, bond returns will increase. Also, if you look at the volatility of a bond index fund like AGG, it only has a volatility that's slightly more than a 3 to 7 year bond index fund. And it's those long-term bonds of 10, 20, and 30 years that are most vulnerable to interest rate increases. So, if some advisor tries to convince you to dump the bond portion of your portfolio, let alone any portion of your portfolio, into an annuity, walk out the door, hang up the phone. You are dealing with a commission-based salesman. By the way, according to Annuity Think Tank, moving forward in today's low interest rate environment, you can expect to see returns of between 2 and 5% with an index annuity. So folks, do yourself a favor, study the historical returns of bonds and stocks so that you can make educated decisions on your own.